A global recession is coming. This is the warning from the FedEx CEO, and we gotta listen. So, the earnings for FedEx just came out and it's horrible. It's a bloodbath with earnings per share dropping over 33% and revenue dipping over 1%. And it's no surprise that their stock price fell by over 23% in just one day. We need to understand how important FedEx is to global trade. They are essentially a global delivery service that connects buyers and sellers across 220 countries. So, a slowdown here is telling us one dark truth: global retail sales are slowing down. Now, according to FedEx CEO Raj, global volumes declined as macroeconomic trends significantly worsened later in the quarter, both internationally and in the US. And he makes a point when he says, "We are a reflection of everyone else's business, especially the high value economy in the world." FedEx might be the first domino to fall across this retail and trade apocalypse. It is very likely we will see UPS and even Amazon down the line drop in earnings. People just don't have money to spend anymore. It doesn't matter if unemployment is still low, inflation is red hot, and every dollar is being channeled to food and fuel. But what's really worrying is the company citing weakness in Asia, showing America's biggest customers, especially China, they are just not buying or shipping stuff around anymore. Plus, business from the company's top two clients, Walmart and Target, were lower than expected, showing that discretionary spending in America is cratering. Could it be a consequence of all this out of control inflation? And this is very bad for the stock market. Traders on Wall Street are freaking out and they're starting to realize what we all have long known, right? That's going to happen. And earnings winter is going to come this winter. But what's very concerning is FedEx pulling away their full year guidance. Now, this is very bad news as companies don't normally do that unless things are going to get horrible down the road. It's like the Fed's forward guidance on interest rate hikes. The reason why the Fed gives us clues in advance on what they're going to do is to prevent big market shocks if they suddenly decide to do a jumbo rate hike. Now, the fact that FedEx pulled their forecast just shows the economic conditions are going to get worse down the road. But the shocking thing is how mainstream media is still acting like this is just one company's poor performance. It's not, guys. It's the entire economy circling the toilet, and FedEx performance is simply reflecting the truth of global trade and consumer demand today. And if we compare the charts of the S&P with FedEx, we can see a rather tight correlation between the two. Both the S&P and FedEx tracks each other closely, but now we see FedEx endure a horrific crash while the S&P hasn't caught up with reality yet. And this tells us that FedEx might be the canary in the coal mine when it comes to the beginning of a horrible earnings season, and maybe the stock market as a whole is still sleeping on the news. A bigger crash might be around the corner. And taking a look at the US consumer sentiment, it is obvious that people believe the outlook for the economy is still very bleak. It is near all-time lows, even worse than the great financial recession of 2008. And when we cross-check this with the Consumer Confidence Index, which tracks how optimistic or pessimistic consumers are, we see that it's still very, very weak. The Expectations Index in orange shows that consumers believe their incomes and jobs are still under tremendous pressure. People are going to spend less and save more money, which is obvious if you believe the economy is going to spiral deeper into recession. Now, retail sales are still going up, increasing by 0.3% in August, but the numbers are very misleading. This is a case of how statistics can tell the truth but lie at the same time. Now, firstly, the month was carried by auto sales, and we still haven't factored in inflation yet. Remember, inflation for August was 8.3%. So it is the higher prices that are inflating the retail sales numbers, which are measured in dollars. And if inflation was below 2%, maybe the rise could be meaningful. But because inflation is still so high today, we're actually seeing real spending crater. Just a few months back, we can already see retail sales after adjusting for inflation crashing down. And this brings us to Wall Street's biggest fear, an earnings recession that's coming down the line. Because you can conjure as much hype as you want and the White House can deny that we are in a recession, but you cannot argue with hard numbers. If a company's earnings fall, it will bring down the stock price, but this time, the price to earnings multiples are going to come down as well. If we look at the Shiller P ratio of the S&P, which is inflation adjusted, we can see we are still in bubble territory. The median P ratio is around 16, while we are still over 28 today. And this is not a good sign. Stocks are still overpriced because investors still believe earnings are still going to be high. And that's why FedEx earnings crash is a big wake-up call to all the fat cats on Wall Street. We have been talking about earnings recession for a long time. Michael Burry has also been warning that consumer spending is going to dry up by Christmas, but no one ever listens. And finally, the big banks on Wall Street are waking up to reality. We have Morgan Stanley and Goldman Sachs warning of higher rates and shrinking margins that will crash US earnings. Now, BlackRock is also warning of earnings cuts coming for stocks, and it's going to drag all the way into 2023. Profit downgrades are going to be severe for the equity markets because investors' expectations will be adjusted to the downsides. So not only will earnings drop, investors with a functioning brain will want to pay lower multiples on those earnings to own the stock. It's like a rating agency taking a bond from AAA down to BBB. It gets harder to sell to investors. People will only buy it at a good yield, and this is going to come for the stock market. Stocks in general are going to get downgraded in a sense. And we need to understand how Wall Street works. They are always wildly optimistic and lagging behind reality, especially during the '08 crash, because the way they make money is by people investing their cash month after month. The bulk of money made there is through commissions from transactions. If people are spooked out of the market, transactions will drop and Wall Street loses revenue. Is as simple as that. And that's why the S&P earnings estimates are just too high. It is not reflecting market expectations. Everyone is hoping for the best. Analyst estimates are still at a record high because they don't want the party to end. So we're going to encounter a vicious earnings cycle that will get worse as we move towards December as winter hits Europe. Remember, the retail apocalypse and global trade slowdown aren't just confined to America. Europe's energy crisis is going to force people into making huge spending cutbacks. Europe is going to have to hike rates for two simple reasons, right? Inflation is at an all-time high of 9.1% thanks to the gas supply crisis, and the Federal Reserve is front-running the world in terms of raising interest rates. They just did it with 75 basis points earlier today, and the ECB, they are also raising their interest rates by 75 basis points, but they're doing it from zero, and it's just not enough. And I want us to understand this simplified earnings cycle from hell, and you can see what's going to happen. So when the ECB and other central banks around the world start to hike rates, a deadly domino effect could start playing out. Higher rates means money will get harder and more painful to borrow for companies. That will translate into slower growth at a time when wages are still high and input costs are through the roof thanks to inflation. And what does this mean? Layoff season is coming soon. It's the exact situation being played out in FedEx today. They are going to close 90 office locations, cancel projects, freeze hiring, and trim working hours. And once people start losing their jobs or have their hours cut back, they have less spending power, right? And this means company earnings are going to drop again. They will experience even lower growth, and the deadly cycle repeats itself. The stock market will likely continue to crater even more, at least for the next few months, as Europe faces an energy apocalypse. And right now, we have reports of factories in Germany being forced to shut down and lay off workers just because the electric bill is too high. In fact, we have German economists predicting that their economy will shrink by 0.3% in 2023, forecasting a recession that everyone knows is coming. And when the world suffers, America also suffers. We can see companies in the S&P 500 that's more exposure overseas are hit worse in a recession compared to the more domestic American companies, around 5 to 10% more on the downside, which will drag the index down as a whole. And this is the beauty of globalization, or maybe the horrors of globalization. We all make money together, or we suffer together. And we are already in a recession. The big question is, how bad can this get? And if we look at the Federal Reserve's GDP forecast, we can see things are going to get considerably worse. The New York Fed's DSGE model paints a very bleak picture of what's to come. It shows that the GDP growth for this year and 2023 are negative, and this means the recession is going to continue for at least the next 18 months. We are going to see the economy shrink by 0.6% in 2022 and 0.5% next year. So the American economy alone is going to have a prolonged recession without even factoring a global slowdown and a situation in Europe. Now, if we look at the more popular GDP now forecast from Atlanta Fed, we can see they have downgraded their Q3 GDP prediction from 1.2% all the way down to 0.3%. That is a big drop, which shows the economy is slowing down dramatically. Right now, we have 2 quarters of negative GDP growth, and the third quarter numbers will only be released in late October, so there's still room for the numbers to fall even further. And if we do have a third quarter of negative GDP, then we are knee deep in a recession, and I don't believe you can redefine it away again. And when that happens, the stock market will catch up with reality finally, and a bigger crash might be underway from late October all the way to December if we really get 3 quarters of negative GDP growth. And at the very least, we would likely test the June lows of 3,700 again. And in the letter to their clients, Goldman Sachs believes the S&P will crash further as the Fed continues to hike rates. Remember, as rates go up, unemployment will eventually rise as well. And according to Goldman, if unemployment hits 5%, the S&P will drop below 3,400. And if the jobless rate hits 6%, the S&P will crash below 2,900. And if we look at Goldman's projections, we can see that their two hawkish scenarios are within the realm of possibility and even less severe than the 2008 housing crash. And this is a very scary warning that we shouldn't dismiss. When people are jobless, they have no money. And when they have no money, spending and earnings dry up. Now, obviously, anything can happen with the economy, but the signs are not good. We have a global slowdown incoming as the world's central banks are ready to hike rates together. And this is going to start with the Fed hiking rates by 75 basis points or more. It's going to come and it's going to be brutal. We're going to see a bunch of global central banks start to defend their currencies against a surging dollar with their own rate hikes. Sweden's central bank just hiked its rates by a full percentage point, while the Bank of Canada just hiked theirs by 75 points, and they are not stopping. Remember, if they don't, the dollar will get stronger and crush their currencies, which means higher inflation, which will make everyone poorer. So it's either you cause demand destruction together with the Federal Reserve, or you risk double-digit inflation. And right now, they have chosen the route of demand destruction, and we'll continue to see asset prices collapse. Doesn't matter if it's stocks, gold, silver, or real estate. The next 6 to 18 months are going to be very painful for the markets. So let me know what you think in the comments below. Is the global economy already slowing down? How bad will things get when winter comes? Let me know in the comments below. Stay safe. Be sure to smash that like button and subscribe as we navigate through these trying times.